May 18, 2012. 11 a.m. Eastern. 3,000 Facebook employees are watching a 28-year-old in a hoodie ring a bell. Some of them are crying. Some of them are about to become millionaires. The confetti hasn't even hit the ground. They don't know it yet, but they're standing in the wreckage of the worst tech IPO of the decade. In 90 minutes, the stock will start to fall. In 4 months, half of it will be gone. $50 billion in wealth, vaporized in front of the entire world. Mark Zuckerberg will be called the worst CEO in Silicon Valley. Analysts will demand his resignation, class action lawsuits will rain down, and the financial press will pronounce, with the kind of certainty only the financial press can pronounce, that Facebook is finished. They're all wrong. Because over the next 90 days, that 28-year-old in the hoodie is going to do something so reckless, so completely unprecedented, that it permanently changes how Silicon Valley thinks about disaster. He's going to bet his entire company on a single decision, and he's going to win. This is the story of the 90 days that built modern Meta. Instagram, WhatsApp, the AI race, the trillion-dollar valuation. All of it traces back to what Mark Zuckerberg did between June and September 2012, when everyone else thought he was finished, and almost nobody tells it. 8 years earlier, a 19-year-old sophomore in Kirkland House dormitory sits at his desk at 2 in the morning. He's drunk. He's recently been dumped. He's very angry. His name is Mark Zuckerberg. He's about to do something that will get him hauled before the administrative board and nearly expelled from Harvard. He's going to build a website. The website is called FaceMash. Here's how it works. He pulls photos of every female undergraduate at Harvard from the university's online directory without permission, and builds a site that displays them in pairs and lets users vote on which one is hotter. He launches it that same night. By morning, half of Harvard is using it. By afternoon, the network has crashed. By evening, Mark Zuckerberg is sitting across the table from a Harvard administrator, trying very hard not to get kicked out of school. Here's what's interesting. Nobody remembers the apology. Nobody remembers the disciplinary hearing. What people remember is what he learned that night. In a few hours, he had discovered something that every social media company since has tried to bottle. If you give people a way to look at other people, they cannot stop. 4 months later, on February 4th, 2004, in the same dorm room, he launches the Facebook.com. It's a directory, a list of Harvard students with their photo, their major, and one line for relationship status. No newsfeed, no like button, no status updates, no filters, no stories, no reels, no algorithm, just faces. And here's what nobody at the time understood. That was enough. Within 24 hours, 1,200 Harvard students signed up. Within a week, half the campus. Within a month, the platform spreads to Columbia, Stanford, and Yale. Not because Zuckerberg launches it there, but because Harvard kids tell their high school friends, and those friends demand their universities get on the list. Within a year, he had 1 million users. Within 4 years, 100 million. Within 7 years, 800 million. Let me put that in perspective. The iPhone, considered the fastest growing consumer product in modern history, took 6 years to reach 100 million users. Facebook did it in 4. Television took 26 years to reach 50 million American households. Facebook took 3. This isn't a successful startup. This is a phenomenon, a generational shift in human behavior, happening in real time, just from a dorm room in Cambridge, Massachusetts. However, this created a problem no one was expecting. Growth like that costs money. Every new million users means more servers, more engineers, more electricity. So between 2004 and 2011, Zuckerberg raises money from anyone who'll write a check. Peter Thiel writes the first one, $500,000 in summer 2004, for 10.2% of the company. If Peter Thiel had simply held that stake, done nothing, made no other decisions, just kept the shares, it would be worth roughly $100 billion today. He sold most of it years before that. After Thiel comes Accel Partners, then Microsoft, then Goldman Sachs, Russian oligarchs, sovereign wealth funds, a Time magazine Person of the Year cover. By 2011, Facebook has raised more than $2 billion in private capital and is valued at $50 billion on the secondary market. And every one of those deals had to give out something. Stock to investors, to early employees, to consultants who'd helped, to engineers from acquired companies, to anyone who'd had a hand in turning Facebook into what it had become. What nobody outside Facebook fully realizes, not the board, not the lawyers, not Zuckerberg himself, is that they've given out too much. In 2012, federal securities law had a rule. If a private company crossed 500 shareholders of record, it was forced to start filing public disclosures with the SEC every quarter, every earnings report, every executive compensation detail. All the burdens of a public company without the access to public capital. By late 2011, Facebook was about to cross that threshold, and Mark Zuckerberg did not want to go public. He'd said so publicly, repeatedly. He didn't want quarterly earnings calls. He didn't want a board that could fire him. He didn't want to optimize for a stock price. He wanted to build. But the math had already decided for him. On February 1st, 2012, Facebook filed its S-1. The filing landed like a meteor, 845 million users. That's 1 in every 9 humans alive on Earth. $3.7 billion in revenue, $1 billion in profit, profitable for 3 straight years, the fastest growing platform on the internet, in 70 languages, in every country that wasn't actively blocking it. The financial press lost its mind. Goldman Sachs had valued Facebook at $50 billion privately 12 months earlier. Now the rumors started. A $100 billion IPO, the largest tech IPO in American history, bigger than Google, bigger than every .com IPO combined. Literally everyone wanted in and asked how to buy shares. Brokerages reported the highest call volume in their history. This wasn't a financing event anymore, it was a cultural one. And in the middle of all of it, with the entire financial press watching, Mark Zuckerberg flew to New York for the IPO roadshow, wearing his hoodie, of course. Wall Street called it disrespectfully, and an analyst called it, quote, a mark of immaturity. The hoodie became briefly the most discussed piece of clothing in finance. But the hoodie wasn't the problem. The problem was inside the company. Here's what nobody outside Menlo Park understood. While the bankers were valuing Facebook at $100 billion, the company's user base had been quietly fleeing desktops for over a year. By Q1 2012, more than half of Facebook's daily active users were on mobile. And mobile users were more engaged than desktop users. More time per session, more posts, more shares. There was just one problem. Facebook had no mobile ads. None, zero. Not a small amount. Not in development. Zero. The most engaged segment of its user base was generating no revenue at all. And buried in the risk factors of the S1, in the part nobody reads, Facebook had to admit it. The Morgan Stanley analyst team read that line and quietly cut their revenue forecasts. Then they did something that would haunt the entire IPO. They shared the cuts privately with their institutional clients, the hedge funds, the asset managers, the big buyers. They did not share them with the public, so the cab drivers and the hairdressers and the uncles at Thanksgiving bought Facebook at $38, believing the bullish numbers. The hedge funds sold, knowing the lower ones. The bell rang at 11 a.m. Eastern, champagne, confetti, 3,000 employees in tears, and then trading was supposed to open on NASDAQ. It didn't. NASDAQ's order matching system had a bug. Billions of dollars in orders flooded the system, and the system started dropping confirmations. For 30 minutes, the largest tech IPO in history happened in complete technical chaos. When the system finally stabilized, Facebook opened at $42, an 11% pop. By the standards of a normal IPO, an 11% pop is fine. By the standards of a hyped tech IPO, it was a disaster. LinkedIn had popped 109% the year before. Even Groupon popped 31%. Tech IPOs doubled. 11% wasn't a victory, it was a warning. By the closing bell, Facebook traded at $38.23, almost exactly the IPO price. What no one outside the underwriting syndicate knew was that the only reason it closed above $38 at all was that Morgan Stanley had spent the entire afternoon secretly buying Facebook shares to prop up the price. Because if Facebook closed below $38 on day one, it wouldn't just be a bad IPO, it would be a catastrophe. The headlines hit Monday morning. By Tuesday, the stock had broken below $38. By Wednesday, under $35. The Morgan Stanley analyst note story broke that same week. Lawsuits started filing within days. Then it kept dropping. $32, $28, $25, $22. By September 2012, Facebook hit $17.55, less than half the IPO price. $50 billion in market capitalization gone. Inside Facebook, the mood was apocalyptic. Engineers who'd left Google and Apple for Facebook stock were calculating what they'd lost. Recruiters who'd been crushing it 6 months earlier started getting their offers politely declined. Employees with locked-up shares watched paper fortunes evaporate by the day. The press was relentless. Worst IPO in history became a standing headline. Op-eds called for Zuckerberg's resignation. CNBC ran an hourly counter of how much the stock had dropped from its peak. Lawsuits multiplied. Class actions from retail investors, shareholder suits, congressional inquiries. The SEC opened an investigation. Mark Zuckerberg was 28 years old. He was sitting at the head of a company hemorrhaging billions in market value every single day, and the entire financial world had concluded he was a failure. Most CEOs in his position would have been pushed out. Some would have quietly resigned. Some would have been replaced by their boards with somebody older, somebody Wall Street trusted, somebody who'd do the cautious, sensible thing. Mark Zuckerberg did something else. He locked the company in. In the weeks after the IPO, Zuckerberg gathered the company. The narrative inside Facebook had to change. The mistake, he told them, wasn't the IPO. The IPO was just where the mistake became visible. The actual mistake was that Facebook hadn't taken mobile seriously at all, users were on phones, the world had adapted, and Facebook was left behind, bleeding out and missing out on so much revenue stemming from mobile ads. Wall Street had figured it out before they had. So here's what Zuckerberg did. His response was to declare what he called a lockdown, a Facebook tradition from the early days when engineers would seal themselves in for 60-day sprints to ship something critical. But this lockdown was different. This one was the entire company, something that had never been done before. Engineers who'd been working on desktop features were told their work no longer counted. New hires were assigned to mobile teams starting day one. The job listings on the careers page were rewritten overnight. Internal performance reviews started weighing mobile contributions higher than desktop. The message was unambiguous. If you weren't on mobile, you weren't on Facebook anymore, so the mobile newsfeed got rebuilt from scratch, and then came the harder problem: how could they build a mobile ad product? The genius of Facebook's desktop ad system had been that ads sat in a sidebar, visually separate from the content users came for. But on mobile, there was no sidebar. The screen was too small, and any ad that appeared had to live inside the newsfeed itself, right in the middle of your friend's photos, your cousin's wedding announcement, your college roommate's vacation, and, well, that was just terrifying. Putting ads directly inside the content stream had been an industry taboo for a decade. Twitter had refused to do it. Snapchat would later refuse. Every social platform on Earth had treated newsfeed-style content as sacred ground, but Facebook did it anyway. The first sponsored posts launched in summer 2012. Weeks after the IPO, they were tested carefully, measured obsessively, and engagement was higher than expected. Click-through rates were higher than desktop ads, and revenue per mobile user started climbing extremely fast. Meanwhile, and this is where the story gets almost unbelievable, back on April 9th, just weeks before the IPO, Facebook had announced a billion-dollar acquisition of a 13-person photo-sharing app called Instagram. The deal closed in September 2012. In the middle of the stock collapse, the financial press was savage. $1 billion for 13 engineers and a filter app, wrote one analyst. It was widely called the most insane acquisition in tech history. Nobody understood what Zuckerberg understood. Instagram was mobile native, born on iPhone. Designed for thumbs, photography first, it was exactly the product Facebook was struggling to build itself. And now, Facebook owned it. On January 30th, 2013, Facebook reported earnings for Q4 2012. Mobile ad revenue had gone from essentially zero a year earlier to 23% of total ad revenue, 8 months after the IPO disaster. 8 months after the worst CEO in Silicon Valley headlines. 8 months after the lawsuits and the resignation calls, Facebook had built an entirely new business inside itself, making the stock pop 25% the next day. By mid-2013, mobile was over 40% of ad revenue. By late 2013, the majority of Facebook's business was coming from a product that hadn't existed 18 months earlier. On July 24, 2013, Facebook stock closed above $38 for the first time. 15 months after going public, the stock was finally back to where it started. Then it kept going. 50, 70, 100. In 2014, Facebook bought WhatsApp for $19 billion and then bought Oculus the same year, betting on virtual reality a full decade before anyone else. By 2018, $500 billion company. By 2021, $1 trillion one. The company we now call Meta. But none of it happens without the IPO disaster. Because here's the truth, the worst IPO in history coverage missed, Facebook didn't have a mobile strategy before the IPO. The reason it built one wasn't visionary leadership. It was that the public markets had publicly humiliated the company into doing it. The IPO didn't almost destroy Facebook by accident. It exposed exactly the problem that needed solving. Most 28-year-old CEOs in Zuckerberg's position would have been pushed out. Some would have resigned. Some would have been replaced by their boards with somebody older. Somebody Wall Street trusted. Somebody who would have done the cautious, sensible thing. The cautious thing would have been to slow down, rebuild trust with the market, take time, explain. Zuckerberg locked his entire company in a room and forced it to rebuild itself in 90 days. That response, not the IPO itself, not the founding story, not the dorm room or the hoodie or the lawsuits. That response is the actual founding moment of modern Meta. Every product, every acquisition, every trillion-dollar headline traces back to those 90 days when Mark Zuckerberg looked at the worst possible outcome of his career and refused to apologize for it. He just built his way out. That's true leadership and innovation, and that is Meta.